Hi guys, little video here about HMOs. A lot of people ask me, what is an HMO? Why would I want one? What do I need to look for? And what is an HMO is a simple question to answer. You take a house and when you rent it out room by room rather than the whole house as a whole, that is an HMO, a house of multiple occupancy. It's very easy to do. You just put people in each room. There are some regulations you need to check out and I'll cover that later on in the video. But simply you're renting each room out rather than the house as a whole to one tenant. You're gonna have 4, 5 or 6 tenants. A few people might be wondering, why would I wanna buy an HMO rather than a single let? So there's a few reasons why you might wanna buy an HMO and a few things to consider if you are gonna buy one. The first thing I'd say is, you get more cash flow. If you think about it compared to a single let, you've got to have 4, 5 or 6, or maybe even more tenants per house. A single let might net you £200, £300, £400 a month after costs, whilst an HMO is going to net you maybe 600, 800, even £1,000 a month positive cash flow in your pocket after you've paid all your bills, and that's from one property. The other thing to consider is the property this size is likely to be bigger. It's going to cost more. Now, although that means you've got to put more money in to buy it up front, if the whole market goes up by 10%, you're going to make more money on capital appreciation. The property is worth more than an equivalent single let. While you're getting twice, 3 times as much cash flow per property, and you have 4, 5 or 6 tenants versus one, you don't have 4, 5 or 6 times more headaches. You're still going to have one HMO manager for that property, one person who's responsible for ensuring the tenants are happy, sorting out all the maintenance. You're still going to have one HMO manager for that property, one person who's responsible for ensuring the tenants are happy, sorting out all the maintenance, and you'll have less management costs when you work it out when you have one property rather than having 4 or 5 single lets. They're the main reasons why you're going to want to get them, but above all else, it's cash flow. You make more money per property. If you need to make £6,000 a month to cover your living expenses and quit your job, then you're going to need probably 8 HMOs. If you want a single let, you're going to have to get a lot more than that. You're talking maybe 20 properties really to consistently hit £6,000 a month. Now, what do I need to consider when I'm letting out an HMO? Well, if you're going to buy an HMO, there's a few things you're going to look for. The first thing is Article 4. People have mentioned Article 4 in the past. You'll see it written all over the place. The end of HMOs, as it will say. Article 4 isn't the end of HMOs. There are a lot of cities that have Article 4 in there, and all Article 4 means is that you cannot convert a regular house, a C3 dwelling, if you will, into a C4 dwelling, which is an HMO, without going through planning permission. Now, you can do this, and there's nothing really to stop you going and buying a house and going through planning, but you can't guarantee that you're going to be able to let it out as an HMO. You can't guarantee they're going to grant you permission to do so. If that happens, you'll be left with a house you can't rent out as an HMO, and you're probably going to have to rent it out as a single let, and your return's not going to be very good. However, you could just buy an area where there isn't Article 4. And if you do that, and you know an area that is going to be Article 4, because I have to announce it 12 months in advance, you can benefit from something called grandfather rights, which means if you buy a house, convert it to an HMO, and then afterwards Article 4 comes in, you can continue using that property as an HMO, and the value of that house will have gone up. A lot of investors like buying in existing Article 4 areas. They like buying ready-made HMOs. And if your house is already set up as one, it's already compliant, and it's in an Article 4 area, the likelihood is the value of the property is going to go up. I know an example, an investor friend of mine bought a house in Wolverhampton before it was Article 4, 2 months before it was Article 4. He bought it for £135,000. It was I believe it was a 5-bed. He rented that out and he was making about £850, £900 a month for that. 3 months later, 3 months after he bought it, someone offered him, this isn't a value, they offered him £210,000 for that property. He was then able to refinance his property. He didn't sell it. He refinanced the property and pulled out a lot of cash. That is a particularly good example of when Article 4 has benefited the capital appreciation of a property. So Article 4 is not the end of all HMOs. The second thing I'll say is licensing. Licensing just basically means a property that is an HMO needs to meet certain standards for the tenants. Things like fire doors, fire alarms. In some places you need to look for soundproofing and things like that. You can find all this information online on the government website. Just Google, say for example you're looking in Coventry HMO requirements. And you can look through there, go through the council's website. There'll be a help pack or a guidance pack for landlords. If you click on that and read through, it'll tell you everything you need to be aware of when you're buying an HMO, or everything you need to do to a house to make it compliant as an HMO. You will then need to get a license on that property, and you can do that quite easily. You just have to apply for one and then you can rent it out. Don't even need it. It'll probably cost you £100, £200 or £300 a year depending on the property. They'll come out and they'll survey it. It's not actually that difficult. People get scared, but it's not that difficult. Usual compliance costs for a property are between £5,000 and £7,000. You might do it for less if stuff's already been done or it's a small house. But typically about £5,000 is a pretty good estimate for what you're going to need to spend. Something else you need to be aware of when you're buying an HMO is, will it rent out? Now, any house will rent out for the right price as a single let. For an HMO, it's a little bit more specific. You need to know more about the market. You need to know more about the area and the demand for that. Now, you can check that on things like spare room. You can go on open rent and have a look at what else is rented as a single let. And you can look at the demand for people looking for rooms in cities. Now, cities tend to work best. Now, not all cities work as well as others. London, for example, is very, very good for tenants for HMOs, but the houses are very, very expensive, so your return isn't that great. Manchester's very good, Birmingham's very good, but you can go to smaller cities as well, things like Walsall. Is it a city? Yeah, I suppose you might say it is a city, but it's not very big, but it's on the outskirts of Birmingham, and that works very, very well for HMOs. So always check your demand in your area, and always, as always, get information from the local agents, the local investors, the local people who have properties there that know about the market. And the last thing you need to check when you're getting an HMO is when you're calculating your return on your investments, you will be paying for the bills, for the council tax, the water, the electric, the management. You pay for everything. Whilst in a single let, you're probably not going to pay for the gas and the electric and the council tax. When someone rents a room, they're going to have bills included. That means you need to sort out everything for them. They just come in, they pay their set amount per month, they get keys to the property and they pay for their food, and everything else is sorted for them. This is really convenient, very much the same as the halls or the student accommodation you would have lived in at university if you did that. And it's a very common way of living. People like it. You meet really good friends. You can make really good connections. The properties tend to work pretty well. You might have some disagreements from time to time, but on the whole, tenants actually quite like living in HMOs. A lot of people have done it when they're at university, as I said, and it's cheaper to rent a room than it is to rent a whole house out. Even if the rents look similar, you get your bills. And having bills included is a big thing. If you think average bills for a house are £200, £300, you're not paying for those. They're included in your rent. Now, as a landlord, obviously that's split across the 4 or however many bedrooms you've got in your house. So just bearing that in mind when you're calculating your return on investment, you've got to include all of those in your figures. And you'll be left with probably a minimum of £600 a month cash flow profit on an HMO. Thanks so much for watching, guys. If you're interested in investing in property or you want to learn more about HMOs and strategies alike, why not check out Samuel Lee's YouTube channel and his Facebook group. He also runs a 2-day free course called the Crash Course. Highly recommend going on that. He'll find these deals live in front of you and he'll give you lots of information about how that works. Thanks for watching, guys. See you soon. Bye-bye.